Okay, so let's jump into all of this. Joining us now, Scott Wren. He's Senior Global Equity Strategist at Wells Fargo Investment Institute. Scott, nice to see you.
Hey, John.
Why don't we start with the debt ceiling story and could, maybe through the lens of the market. How much attention do you think the market is giving to this story, and what are the ramifications for the market depending on how this story plays out?
Well, I think that the market's paying attention a lot. I think most of today now, people are waiting for an announcement today that's a little more solid than what you mentioned. But certainly, as you go through this trading day, people, if there's no agreement, people aren't really going to go home, exposed a lot. So I think today is largely going to be positioning. If we don't hear an announcement, to go into the weekend where you're not going to get annihilated with a 3-day weekend being either the wrong way on the direction, and the market goes higher or a lot lower on Tuesday. So I think that's what's going on today. Overall, though, the market certainly. If this thing goes to the 11th hour, which history would suggest it would, there's typically more downside. And when you look at things like, we're up against a lot of resistance at 4180 to 4200. We're coming in for a 3-day weekend. We're at the June 1 date practically. Equities are going to have some downside if we go in there if we go into June 1st without some kind of an agreement. But we all know that, some deal is going to get made here. And could there be a technical default where principal and interest doesn't get paid for a few days or a week or something? Sure, there could be. But in the end, the U.S. is going to pay its interest and principal due. Okay,
so we'll see what happens on that front. And to your point, yes, there is this American long weekend, so that would put us closer to the wire if things feel unsettled heading into the weekend. I mentioned the Fed's going to have to keep tabs on this. We already have some new data this morning suggesting that its central bank strategy will be continuously complicated because you're still seeing signs of inflation being elevated and an economy that is holding up, arguably resilient, not necessarily a bad thing, but I think for those who were anticipating in the markets an end to rate hikes, that's a complicating factor.
Hey, you mentioned just the data this morning. Personal spending was pretty good. PCE's hanging up higher than what the Fed would like to see it. Business capital spending's pretty good. So, we expected inflation to go down, and it's certainly gone down, but we expected it to get hung up somewhere, and it appears to be hung up now. Now, is that going to be the story for the rest of the year? We don't think so. I mean, we think CPI will be below 3% by the end of this year. But for right now, the Fed is certainly watching the debt ceiling. It knows what these economic numbers are, that inflation's too high and the economy's probably a little bit too strong and the labor market's probably a little bit too strong. So for us, I mean, I don't think, if inflation hangs up here, I don't think the Federal Reserve is going to be finished hiking rates. They're pretty close. If we're right and inflation continues to go down after stalling here for a little bit, I think we'll be in good shape. But the Federal Reserve is going to fight inflation, and if inflation doesn't come down from these current levels, we're going to see rates go higher later in the year at some point.
I mean, it is a tough call. You got a chorus of economists who point to some potential notable declines in inflation as we get into the back half of the year. But for now, I mean, even here in Canada, I made the point that we've got a Bank of Canada that's been on the sidelines their last couple of meetings. And since the current inflation numbers are still elevated, now there are some who think in the short term in June, like the Fed, who knows, maybe they got to keep raising rates. Against this backdrop, and I'm hearing it in your voice, it sounds like you're still sort of leaning into defense when it comes to portfolios.
We're definitely, and you and I have talked a lot over the last year, 15 months, John, and we've been playing defense. We continue to do so. Our conversations, as I mentioned before, are, not really how are we going to get more defensive and hide more from here. It's what's our timing to get more assertive. So if you think there's going to be a recession in the second half of the year, which we do, ideally, and if the timing's right, about halfway through the recession, that's when the market starts to look forward to brighter skies. So the defensive positioning we have now, ideally over the next, let's call it 6, 12, 18 months, is going to evolve into something that's more sensitive to a recovery, whether it's from just a slowdown or the recession we're looking for. So right now, I think you want to play defense. We've moved cash from equities into short-term bonds. We want to look for an opportunity. You get a big sell-off next week based on fears over the debt ceiling. that's an opportunity. So we're looking at any downside as an opportunity, trying to look out into 2024 and the likelihood that the economy is much better, inflation's down, the Fed's not hiking rates, and the global economy is in better shape too.
Okay.